Welcome back to Bazaar Morning Call. The big disappointment today could be Infosys, but TCS, on the other hand, reported a well-rounded set in the fourth quarter. Before we analyze the numbers threadbare, here's a word coming in from V. Ramakrishnan, the CFO, who spoke to my colleague Rima. We'll be back.
On margins, now FY19 you had a massive rupee tailwind. The rupee depreciated by nearly 8.5%, yet your margins appreciated by only 79 basis points.
There was the rupee depreciation, no doubt. But at the same time, you must also know that we have our salary increases, etc. So if you really look at it, the wage, whatever salary increases, etc., are really funded by the rupee depreciation. So they almost, if you look at the numbers last year, they cancel out each other. So the 79 basis points improvement is essentially coming out of a lot of operational efficiencies.
Now come in FY20 with the assumption that we don't have the currency tailwind that we have. Wage hike will be a headwind. So therefore, will margins in FY20 be lower than FY19?
See, something where we will look for if it definitely it will help to take care of some of these increases. But there will be always movements in currency. So if there is no, if it remains flat, to that extent, yes, it will have an impact.
All right. We will analyze Infosys and listen to Salil Parekh as well in just a minute. But first, TCS, Girish Pai, Head of Research at Nirmal Bang Institutional Equities with us. Good morning, Girish. Well, you were downbeat when we were doing the quarter tak preview of the numbers. Does TCS make you a little less pessimistic? After all, it's a margin, I mean, the margins are not that bad. The revenue is a beat.
Yeah, so Q4 numbers have been in line with what we were anticipating. I think we would have been happy if the company had come out and made an explicit comment on FY20 that it would actually grow in double digits. So we had an exit
but
rate.
They don't give guidance normally. Could
they
you
do not
read between the lines?
So the way I read in between the lines was that Mr. Rajesh Gopinathan came out and said that there were some issues in certain pockets of the verticals that they were addressing. So in the BFSI space, he specifically mentioned about capital markets area. There have been issues in the automotive side and the high-tech manufacturing side. He also mentioned, I think in one of the interviews that he did with you, that some clients are pulling back. So there are, while the company doesn't say that they're getting impacted by macros, they do say that some clients are pulling back. The other point that I want to make on TCS is that on the margin front, last year they had a very big tailwind from rupee depreciation of almost like 200 basis points. Now, unless we see a similar kind of depreciation in FY20, my sense is margins will have to come off from where they are right now. The other big point I want to make is that TCS has been making this point that rupee is an intrinsic part of the Indian IT services paradigm. But when I look back in the last 5 years during the Modi era, rupees only depreciated by 2.8%. That's because inflation has been low. 4.3% has been the inflation. You go back in UPA 2, inflation was 10% and depreciation was 5.5%. So if you do have Modi coming back, it may not be great news for the IT services sector, because if Modi focuses on inflation...
No, I think you're focusing too much on the government. There is global deflation and that also kept... and which may continue. So I take your point that global deflation could keep rupee appreciated. I mean, that point is taken. So basically, you're not positive even now on
No, so
TCS.
our call is not so much on FY20. We believe that FY20 is largely factored in. If you look at the PE multiple of both these companies, they're trading at one standard deviation above the 10-year mean. So the good news is already in the price. Maybe today we'll probably see a TCS go up a bit. But beyond that, if you look at FY21, I'm not so sure whether what the street is anticipating from a 9 to 10%, or maybe some are expecting 11-12% kind of growth in FY21 is actually going to come true. Because I don't think US economy is in as great a shape as it was even in 2018. So that's basically our point.
Actually, that also brings us to Infosys, right? I mean, all-time low margins in Q4 at 21.4%. I don't think too many people on the street really expected this. So let's do one thing. Let's listen into what the management, Salil Parekh, had to say about the margins and the headwinds for the sector. And then we'll come back and ask you your view on Infosys. Here's Salil Parekh, the MD of Infi.
Our margin for the full year was within our guided band at 22.8%. And our margin for Q4 was at 21.5%. Going forward, we see the ability now to drive operational efficiency into our business. Overall, we see our business being more stable and better positioned to benefit from the shift to digital. in the years to come ahead, and also to build business resilience into our model. All of that leads us to our guidance. Our guidance for fiscal 20 is revenue growth in the range of 7.5% to 9.5% in constant currency, and margin in the range 21% to 23%. Our margin for the full year was within our guided band at 22.8%, and our margin for Q4 was at 21.5%. Our guidance for fiscal 20 is revenue growth in the range of 7.5% to 9.5% in constant currency, and margin in the range 21% to 23%.
Okay, so that's the word coming in. Girish, as we discussed, it came as a big shock to the street, the margins. Do you think because the stock has rallied so much, 14% this year, there's a scope for a further downside in the near term?
See, I think people are anticipating a PE multiple discount compression between TCS and Infosys because people are believing that Infosys will actually grow a little faster in FY20 versus FY19. So I think that I still continue to believe that, but I think this margin issue has come as a bit of a shock. My sense is while the street was anticipating the margin band to be between 21 and 23, the way the companies exited out of Q4, my sense is probably in FY20, it's probably going to come at the lower end of the band rather than in the mid part of the band. So that's where the concern really lies right now. On the revenue side, obviously, the company actually came out explicitly and said that they've had to renegotiate or redo some of the contracts that they've worked on. So there could be some issues. So you do have a total contract value number which is there on paper, but whether it actually translates into revenue is something that one needs to watch out for.
Okay, so do you expect an expansion in the discount that it will suffer vis-a-vis TCS? Yeah,
it could. In the near term, I do see that. But because I think in the run-up to the results, I think there was a contraction that happened because of this this thought that there could be a compression in growth. I mean, the Infosys will actually grow faster than TCS and margins will not come off very dramatically. But now that's changed a bit.
Okay, and any quick word on Wipro? It comes out with numbers tomorrow. There's that buyback expected as well?
Right, so I think we are anticipating somewhere close to 1.5% kind of constant currency growth for Wipro. I think it's been a laggard.
Lackluster numbers.
So let's see finally what kind of guidance they give for next quarter, because that's typically a weak quarter for Wipro. My sense is if they give you a 1% plus kind of a QOQ growth number, it should be taken slightly positively because typically it's been a very weak quarter on a QOQ basis.
Okay. All right, Girish, pleasure having you with us. Thank you very much for joining us. Okay, with that, let's move on to more trading strategies, this time from the FNO space. Vinod Sharma of HDFC Securities is with us. Good morning, Vinod. So what are you trading now? IT stocks, TCS?
Yeah, good morning, Lata. Good morning, Sonia. Obviously, it's a no-brainer. The ADR tells you all the story. But between them, I think it's always TCS has given and will continue to outsmart Infosys for this year as well. That's what we think. But I think with the ADR opening 4% higher, I don't think there is a trade here at this moment of time. Should it come down by maybe give it let's say 2% or so of the gains, I think it is a trade that can be done in TCS. Okay. But today I'll focus more on the FMCG space and some pharma companies.
Starting with
starting with ITC, of course.
Okay.
ITC had given a very clear breakout on Friday. There are no mincing of words. The volume was high, and clearly 306 is a clause that the market will take with both hands. And I think, so therefore, since it has risen quite fast, so I'm going to do just a bull spread here. I'm buying the 310 call at 3.75, and I'll buy the 320, I'll sell the 320 call at 1.05. So my cost will come to 2.70, and my profit, maximum profit is 7.3 rupees. So the risk reward ratio is very much in the favor of the buyers. So you should construct a long bull spread here. So ITC, Dabur is something which we believe has beginning to make a comeback. So in the overall series, though the stock has gone down by 1%, the OI has been added as 21%. And yesterday, on Friday, the price action was on the high side. So I'm buying the 410 call in Dabur at 8.5 rupees, stop loss 6 and target of around 14.
Okay, you have a couple of more calls actually, some of the smaller companies.
Yeah. Divi's Lab is another one from the pharma sector which we like. I think 1740 call I'm buying, and at around 30 rupees, stop loss at 23 and target of around 45. And Eicher Motors is one of those auto stocks which is make a comeback. There is no hope that it will cross the all-time highs that it has made, but nevertheless there is some more room to be had in this particular stock. So I'm buying the 21,500 call at 4.45 and at 445, stop loss at 300 and a target of around 750.
Okay.
Nifty of course continues to be the same range which your people have so well stressed out.
All right. Thank you very much, Vinod. Have a good trading week ahead. It's truncated and we're all, there's a spring in our step as well. Thank you very much for joining in. Okay, well, with this we shift now to an important corporate conversation. All eyes are on the Reserve Bank after Indiabulls Housing and Lakshmi Vilas Bank announced their intent to amalgamate. The announcement came earlier this month, but that amalgamation is probably some months away because it awaits RBI nod. In the meanwhile, Lakshmi Vilas Bank has to shore up its capital because it is capital inadequate. It had a board meeting on Friday. Thereafter, I caught up with Parthasarathy Mukherjee, the Managing Director and CEO of Lakshmi Vilas Bank, and first began by asking him how this preferential allotment that he announced on Friday to Indiabulls Housing will be done, what will be the merger ratio, what will be the price at which it will be done, and what it does to his capital.
As per regulation, we need to calculate backwards and arrive at a relevant date. And on the relevant date, we'll arrive at the swap SEBI price. And depending on whether the SEBI price is higher or the swap price that was originally arrived at is higher, we'll go by that.
Okay. Well, 4.99. Now, before I get to other questions, did you look at other options other than Indiabulls before you all started talking to them?
Well, Lata, you'll be aware that the bank has been trying for, well, now more than a year to raise capital. We've looked at various options. We've involved a number of investment bankers at this. There were a number of private equity investors that we were engaged with. We did receive a few M&A proposals also. At the end, of course, as you can realize, time was running out for us as far as capital raising is concerned. And this particular transaction materialized. Okay. So we went ahead.
Okay. Now, with this 4.99, what will your capital adequacy come to?
Well, you'll appreciate that before that we need to complete the exercise for 31st of March. This will come obviously subsequently.
So, okay, as of now, what is the capital adequacy?
The 31st March numbers are being finalized because a whole lot of things to be closed, including provisioning and so on. But my sense is obviously we are below the 8.875 that was required.
Okay, okay. Then likewise, your net NPA will also be above the PCA threshold. I think the last was 7.65 and you need to be below 6.
That's
By
right.
March 31st, is that likely?
It's something that we are working upon, and I can't give you a definitive number. There is a possibility it could be marginally higher, but well, we're still.
But it will be lower than 7.6.
Definitely.
Okay. No. Now, what will be the effective date of this money, preferential offer money from Indiabulls coming to you?
That's being worked out. We just arrived, applied yesterday. I think it will be somewhere around later this month.
Okay.
But that date hasn't been finalized yet.
All right. No, why I'm asking you is, I think your EGMs for the amalgamation with Indiabulls is later.
Yeah, that's correct.
Okay. So Indiabulls is taking a bet that hopefully RBI will give approval.
Presumably.
If that doesn't happen?
Well, obviously, as you can understand.
They stay as financial investors?
That's correct.
Okay, okay. Did you not ask RBI earlier? Is there, I mean, if there's some comfort, is there some comfort and that's why you're going ahead with the 4.9?
I'll come to what gives us the comfort, but since you asked RBI, let me answer straight away, no. Okay. There has been no discussion with the Reserve Bank. My own understanding is that the Reserve Bank's process is very simple. They can comment only when they have a plan before them. since the plan, in fact, it's only just now that we've started working on the plan, it will take some time for us to reach out to RBI. Now, to come to what sort of drives us to this transaction. In the first place, let me put on the table the fact that we are strapped for capital, of course. This entity, of course, brings to the table substantial capital. They have a phenomenal business that they have built over a relatively short time, actually, about 15 years or so. We ourselves have been focused on building a retail assets franchise to support the retail bank overall. This is an excellent opportunity for us. I mean, we do anticipate that there would be certain challenges, but clearly they built a tremendous retail franchise, which definitely excites us. So there was a lot of sense in looking at this. We don't deny that there would be some challenges because there is a huge mismatch in size between the two of us. But we are working on that, as to how to handle that.
Okay. Can you give us some color of how the amalgamated entity will look in terms of the various sectors to which you would be exposed? Will there be an outsized exposure to housing finance?
It would be, in theory. It would be. As to how much it would be is something that we can't close out yet because we, first of all, we don't know what will be the effective date of the merger. But between then and now, there could be significant changes in their book. Since this is an issue that everyone has been talking of, and we did notice that they made a statement that they were looking to realign their book also. So at this moment, it would be difficult for us to conjecture, but very clearly, there will be a predominance of real estate exposure for us, including housing loans.
What's your current real estate exposure and housing finance exposure?
Our total real estate exposure is about 5%, so it's not much.
Not much. And what is the retail corporate split?
In the real estate?
No, no.
In the total book,
generally.
the corporate is about 37%. Retail is very tiny, it's about 10% or so.
Okay. Now, what kind of a growth are you looking at in FY20?
I must first tell you that even before this merger was talked of, on the assumption that we would raise adequate capital, it was our expectation that for the next couple of years at least, on a conservative note, we would be growing at a CAGR of 20%.
Okay.
Now with this,
that is an organic number.
That's correct. Now with this particular business coming in, obviously the first year's numbers one mustn't consider. Going forward, one would, I think, safely expect a growth in the region of 25 to 30%.
Okay. You know, Mr. Parthasarathy, the entire banking system went through a huge NPA increase.
Yes.
You're not all that badly placed because your net NPA is still in single digits. Many of the banks can't even boast of that. If you are able to raise capital independently, you can swim independently, right?
Absolutely.
Yeah. Okay.
Absolutely.
It's not that dire a situation. Therefore, what is your plan B? Assuming RBI doesn't agree to allowing Indiabulls to have a banking license.
Our sense is part of that plan B will be played out even before the RBI decision comes because in the meanwhile, my own sense is were this to conclude successfully, even then it will take us possibly about anywhere between 9 months to a year. I mean, going by present track record. In the meanwhile, we need to continue to stay afloat and do business. So it is our expectation is that we will raise further capital. Okay. This one is the first step towards that.
Okay.
So having said that, my own sense is that the bank will very quickly come back to profitability. We took a huge knock. If anything, and you're right, our net NPLs are still perhaps, I mean, it doesn't comfort us, but still it is in single digits. And the intention is to very quickly bring it down well below 3% actually.
Okay.
And
3% in FY20.
That's right. So that's the effort at this present moment. And our expectation is that considering the very sound branch franchise that we have, the network that we have, despite difficult times, the fact that we've been able to maintain our loyal customer base, all this gives us the comfort that we are now